Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of primary market versus secondary market, key differences every investor should know. Without the secondary market, investing would feel like a one-way trip. Once you buy, you're stuck. Instead, it gives you flexibility, much like being able to exchange unwanted concert tickets online. Participants in the secondary market. Several key players keep the secondary market running smoothly. These participants facilitate trades, ensure proper functioning, and maintain liquidity. Traders and investors. These are individuals or organizations that buy and sell securities, ranging from casual retail investors to large financial institutions. Brokers act as intermediaries between buyers and sellers, often earning a commission. Think of them like real estate agents but for financial securities. Market makers. Institutions or individuals that provide liquidity by consistently offering to buy and sell securities. They help prevent the market from stalling. Each of these participants contributes to the fast-paced and dynamic flow of the secondary market, ensuring that trades happen efficiently. Examples of secondary market transactions. There are numerous ways securities change hands in the secondary market. Here are some common examples. Stock exchanges. Platforms like the New York Stock Exchange, NYSE, or NASDAQ facilitate the buying and selling of shares. These are the most well-known examples of secondary market activity. Over-the-counter, OTC, trades. Securities traded outside a formal exchange. This includes many bonds or smaller company shares, offering flexibility but often with less oversight compared to exchanges. Electronic trading. Many retail investors use online trading platforms like Robinhood, Fidelity, or E-Trade to buy and sell securities with ease. Forex market. The foreign exchange market is also a type of secondary market, where currencies are exchanged globally. These examples show the wide variety of ways securities can be traded. Whether on large exchanges or informal OTC networks, the secondary market is where investors can act quickly to build, adjust, or liquidate their portfolios. Key differences between primary and secondary markets. Understanding the primary and secondary markets is central to successful investing. These markets might sound similar, but they function in entirely different ways. From how transactions occur to their role in investor strategy, each serves a unique purpose in the financial system. Transaction processes. Transactions in the primary and secondary markets follow different paths. In the primary market, transactions occur directly between the issuer and the investor. Here's how it works. A company or government issues new securities, like stocks or bonds. These are sold to investors, often through underwriters like investment banks. For example, if a startup completes its IPO, the shares you buy come directly from the company, and your money funds their growth. In the secondary market, things shift. Transactions happen between investors, and the issuer doesn't receive any money. When you buy shares of Tesla on the stock exchange, the seller is another investor, not Tesla. This makes the secondary market more fluid, with buying and selling occurring daily through exchanges or over-the-counter platforms. It's like purchasing a used car. Ownership changes hands, but the manufacturer isn't involved anymore. Issuance versus trading. The primary focus of the primary market is issuance. This is where securities are created and sold for the first time. Think of it as the launchpad for companies looking to raise funds. Common examples include initial public offerings, IPOs, private placements, and rights issues. On the other hand, the secondary market is all about trading. Here, existing securities are bought and sold between investors. The primary market offers a starting point, but the secondary market ensures these securities remain liquid and accessible for future trades. Essentially, the primary market builds the products, and the secondary market acts as the store where they're exchanged. Market regulation. Both markets fall under regulatory frameworks, but the level and type of oversight differ. The primary market is more tightly controlled because it involves issuing new securities. Issuers must comply with extensive regulations, including disclosure requirements and approvals from authorities like the SEC in the United States. This ensures transparency and protects investors from fraud. The secondary market, while still regulated, focuses more on ensuring fair trading practices. Stock exchanges and governing bodies monitor activities to prevent manipulation and enforce rules around transparency. While regulations exist in both markets, they're usually stricter in the primary market to ensure new securities are issued ethically and legally. Impact on investors. Investors face different opportunities and challenges in these markets. In the primary market, investors often assess potential growth and risk. Since securities are sold at a fixed price, buyers can determine if the offer aligns with their financial goals. However, access to primary market opportunities like IPOs can be limited, as institutional investors often receive priority. The secondary market opens up more possibilities. You have flexibility to buy or sell securities whenever you want, giving you control over your portfolio. Prices fluctuate based on market trends, offering opportunities to profit or suffer losses. This constant movement makes it ideal for both short-term traders and long-term investors refining their strategies. Ultimately, the primary market provides the foundation, while the secondary market keeps the momentum alive for ongoing investment activities. Both play critical roles in shaping investor decisions and the broader financial ecosystem. Conclusion. Deciding between the primary and secondary markets isn't about picking one over the other, it's about understanding how they complement each other. These markets work together to power the investment ecosystem, enabling companies to raise funds while offering investors the chance to grow their wealth. Knowing the basics of each market can help you navigate your financial journey with greater confidence. Why understanding both matters. Grasping the differences between the primary and secondary markets is like learning the rules of a game, essential before you start playing. Whether you're a beginner or an experienced investor, here's why this knowledge is key. Informed decision-making. Knowing where and how securities are issued versus traded helps you make smarter choices. Risk management. Each market carries its own set of risks. Understanding them allows you to assess opportunities better. Investment timing. Choosing when to invest, during issuance or in the resale market, directly impacts potential returns. When you understand the mechanics of both, you gain the tools to plan based on your goals and risk tolerance. How these markets shape investment strategy. Your approach might change depending on which market you're dealing with. The primary market is ideal if you're looking for growth opportunities like IPOs or corporate bonds, often with limited supply and high return potential. On the flip side, the secondary market offers liquidity and flexibility, allowing you to adjust your portfolio as needed. Think of these markets as two stages of the financial life cycle. The primary market gives investments a starting point, while the secondary market keeps the momentum going. Both are essential for a balanced, functional system. The role of both markets in broader finance. Primary and secondary markets aren't just tools for individual investors, they're pillars supporting the global economy. The primary market helps businesses and governments raise capital, setting the stage for economic growth. Meanwhile, the secondary market encourages participation and keeps assets circulating, giving the financial system its dynamic nature. So, whether you're buying into an IPO or trading stocks on an exchange, you're contributing to this greater system. Understanding how and why these markets operate makes you a more strategic and informed participant. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.